Good evening, ladies and gentlemen. First of all, let me thank PMS AIF World for inviting me here. Thank you, Akruti, for introducing me, and Kamal. Of course, we have had a short relationship, but it's been a great one so far. The topic I'm going to talk about is about how equity markets have been showing trends of doubling every 3 or 4 years, and what we think will happen in the future. So I'll kind of break it down into the two halves, the history and what I think will happen going ahead. But I must also, to start with, thank Vikas, who actually made this presentation on Amrit Kal, and he's obviously made things very clear as to what will happen till 47. So I don't know why people want to hear what's going to happen in the next 3 4 years. So obviously, primarily we're very bullish on equities in general, and that's why we are here. So let me start telling you a little bit about what happened. To get a perspective of what's going to happen in the next 3 years, we also need to know what happened in the last 20 years. I think the market kind of remembers the post-COVID era, where Nifty, I think, Nifty stocks probably doubled in about 4.5 years. Um, the mid-cap stocks probably mid-cap and small caps actually doubled in less than 3 years, and that's the context I think which everybody has to know what's going to happen going forward. But instead of taking a very short-term view, let's go back to the last 20 years and see what's really happened to India. So starting with 2004, I'm actually not going to my presentation right now because I'll just pick up a couple of slides from there. I'll just talk impromptu. Once I get bored with myself, I'll switch over to the presentation. The last 20 years, we've had obviously lots of bear markets. There's been one mega bull run which happened between 2004 and 2008, which is why I think the 2020 to 2024 phase is kind of compared with that one. But we kind of forget what happened after 2008. Um, Before you get to 2008, 2004 to 2008 obviously was an infra-led kind of cycle. You had lots of infra companies doing well. Banks did very well, I think. Consumer discretionary did very well. And most of the defensives didn't do as well. But then, of course, when the global crisis struck us in 2008, okay, and the 2004 to 2008 period saw Nifty earnings growing by about 28%, which is very, very similar to what we saw in the last 4 years. Last 4 years, Nifty earnings probably grew at about 20% or thereabouts. So that was the kind of level of earnings growth which led to this huge rally, rapid rise in the markets in that phase. So one thing is very clear, that earnings typically drive markets. That's primarily the one. And of course, the re-rating which goes along with it takes the market to extreme levels. But what happened since 2008 is obviously something which people should know. 2008 to 2020, earnings in India slipped to low single digits. And because of which, we rarely saw extended cycles. We saw cycles of markets, the short cycles of markets going up, but there were large phases of markets coming down. I mean, there was obviously, like Vikas had mentioned, there was a global financial crisis in 2008. There was a taper tantrum, US and the currency crisis, which happened between 2012 and 11 and 12. I think demonetization happened in 2016. Then there was a credit crisis, it happened in 2018. And then, of course, COVID in 2020. So that entire phase, we didn't really see the markets do very well. But that doesn't really mean much, because a lot of people must have made money even during that period. There were lots of stocks, a lot of sectors which did well. For instance, FMCG did very well, pharma did well, for example, Hindustan Lever, which nobody talks about nowadays, went up, I think, 5x in that period between 2008 and 2020. There were companies like Eicher Motor, Bajaj Finance, which were multi-baggers during that time. So what I'm trying to say is that it doesn't really matter where markets go or how markets do. You'll always find a group of stocks which will obviously be there to help you make money in markets, and that's our job to identify such companies. So while history does tell us something about what can what we need to be careful about, but it also tells you that one should not be too bogged down by what the index is going to do going forward and things like that. Um, anyway, so I will just break here and just introduce ourselves and tell you what we do, and then I'll get to the future. So we are managing a Cat 3 fund, Cat 3 IF. Me and my partner who's sitting there here, we actually manage this fund together. Both of us have extensive sell-side equity research experience in prominent brokerage houses. And when we started this fund 7 years ago, we were basically learning on the job. We were learning how to manage money for others. So initially we put our own money, and now obviously we're getting other people helping us to help them make money. So that's what our fund is, and okay, and this is what we have done so far, and then I'll get to the future after that. So historically, this is what we have done in the last 7 years. So as you can see, there is a benchmark, which is BSE 500, but we treat ourselves as absolute return fund managers. We don't look at funds from a perspective of trying to beat the Nifty or beat any benchmark. Um, this basically also the philosophy is that irrespective of what happens in the market, we are here to make money, and that's what counts. It doesn't really matter if BSE 500 is a benchmark, if the Nifty small cap is delivering better returns, and that is what our peers are doing. We would like to beat that index, and that's our job. We have been partially successful. There have been years where we have not done well, but by and large, over the last 7 years, we've been fairly consistent, and we have delivered a lot of alpha. So it's a multi-cap scheme. It's not a small cap scheme. It's a multi-cap scheme. So we are sector agnostic and market cap agnostic. And we pick ideas based on what we understand fundamentals of these companies. And we have tried to deliver returns based on that. So that's basically what Ampersand is. So let's come back to the more important things in terms of the market. Um, Before I get to the 2024 and beyond, one must remember that just prior to this 2020, obviously I started with 2004. Prior to 2020, lots of things happened in the market, in the economy. I mean, there was the GST, there was all these reforms which actually took place, but those were disruptive in nature, and really earnings didn't pan out as one had expected in the first era of Modi, in the first 5 years of Modi. And markets clearly reflected that. Markets didn't do well. The first year of Modi coming to power, markets did well. Then markets didn't do well for various phases. And primarily because there was no earnings. But even in that phase, like I said, there were these stocks. I mean, I remember iShare and Bajaj for sure, but there were many small companies which probably did extremely well. So going forward, what's changed for India? What's changed is that post-COVID, the way we have actually managed our economy in terms of fiscal situation, in terms of its current account deficit, at some of the parameters which Vikas had mentioned, which I was also going to elaborate on, but since he's already mentioned that, but that's been a big differentiating factor between where India stands today vis-a-vis the rest of the world and where it was prior to that. So in the past, whenever there was a financial crisis, India used to see these big dips in the market. Today, India doesn't have that problem. Banks are well capitalized. Most of the NPAs are behind. So that's one big thing. The financial system of the country is much, much better. The second is, if you compare India with the rest of the world, if you look at how inflation has panned out, um, the differential in interest between the developed world and India is much lower now, which basically means that also means that India has the cost of capital for India is for Indian companies is much lower. So India is much better placed going forward in terms of how to run their businesses. Um, then you have the forex situation, which is very healthy, and finally, we always had a problem with oil. I mean, if oil. I mean, yes, Russia did somewhat help us during this phase when. Oil was banned, and we took advantage of that. But the fact of the matter is, even today, we are an oil-dependent economy. And that going forward is going to be the big difference because a lot of thrust on renewables and is obviously going to help us reduce the oil shock to a large extent. Which is why I think rather than actually giving you a, a number on where the index will go, because, well, the last 5 years, I've already said that indices have, for example, Nifty, which is what we actually talk with the Nifty, which is what we talk with the market. Nifty has done a 19% CAGR, and Nifty has, by and large, over the last 20 years, been in the mid to high teens. It's the mid and small caps which have actually been up and down, except the last 5 years. So I really don't want to, but it still hasn't mattered because whether you're whichever indices you follow, as long as you're managing a fund, you know that what you invest in, whether it's large, mid, small, wherever, as long as those investments are yielding superior returns, that's what matters. So the point I'm trying to make is that going forward, where the market will go from here, we don't know, really. We really don't know. It's easy to say that Nifty will double in the next 5 years, or mid caps will do very well in the next 3 years, small companies will do well. But as far as our investment strategy and anyone's investment strategy should be, they should be they should be focusing more on stocks, and that should matter. That's it. There are opportunities galore, some of which was mentioned by my earlier speaker. He mentioned several sectors. And I'll talk about this couple of sectors where we are also interested in. But you pick up sectors, then pick up the right stock in that sector, you will make money. For instance, if you had invested in IT in the last 2 years, you wouldn't have done well. But if you had invested in KPIT, you would have done very well. Or an OFSS or something like that. And that's really the bottom line. Get into stocks. It doesn't really matter where markets are going to go. Anybody will make mistakes. We also make mistakes. So the 30 or 32 stocks we own, the lesser mistakes you make, and even if you get out of the 30 companies we own, we make 5 or 6 great ideas, that will be enough to generate the alpha which we have generated in the past. And that's what we actually ultimately look for. So this is the one I was talking about. Just one second. Yeah. So I'll just get to the preferred themes. And the reason I've actually mentioned it like this, but let me try and summarize this first before I actually get to the themes itself. The summary is that India is going to be a consumption-oriented economy, whether one likes it or not. In fact, one has to like it. Now, consumption can be represented by autos, it can be real estate, it can be retail, it can be obviously staples and whatnot. We have seen that the consumption basket, some of the baskets have not done well, some of them have done extremely well. But that's a basket we actually like. But we've chosen premiumization as one aspect of a theme within the consumption basket, which we think is a permanent theme. As India gets richer, more and more people will consume more and more, and it doesn't really matter. You buy whether it's in real estate or whether it's in autos, you basically spend more. And that's a theme which we think is going to have long legs. It's going to be something which could go on for many years. So that's a theme which we like, and we've liked it for quite some time. So I'm not saying this is our best theme right now, but these I'm just giving you kind of a range. This is probably going to be our theme number 2 or 3 right now. The themes which we like incrementally are A, new age technologies, and B, energy transition. Energy transition, everybody knows about. We actually started investing in energy stocks, not utilities, but anything to do with enablers of energy, whether it's renewable or whether it's in terms of equipment, manufacturers or transmission companies. Those are the companies we felt were great investments a couple of years ago, and they still remain great investments. What's changed, obviously, is that most of these companies have run up in terms of valuations. They probably don't, I won't say deserve, they probably are, they scare people in terms of getting in now. And so whether one has to divest this and get into something else or continue holding this, assuming that near term there will be some bouts of underperformance. It depends on what your entire portfolio mix is. It still constitutes a large portion of our portfolio, but it's not as skewed as it was a year ago or 6 months ago. Um, what we like increasingly are the new age technologies, which is happening globally. We know that there are changes happening both in IT and pharma, especially. I mean, India doesn't have any great capabilities to innovate or spend a lot of in R&D in terms of creating a lot of these fancy drugs or innovation in terms of AI or things like that. But we have companies which can enable or can be service providers for these such companies. For example, you have these CDMO companies which are they supply to these pharma innovators in the developed world. And obviously we have that great advantage which IT companies had. You have a lot of chemical scientists getting paid very low salaries, and it's obviously a big advantage for you to actually cater to that huge business opportunity. Already, I mean, a lot of people are now talking of this next opportunity which is coming up in pharma, which is the semi-glutides. There's a whole weight reduction and the diabetes stroke weight reduction program, which actually is going to have this explosive growth. So India is going to see a lot of these companies which are going to be suppliers of the raw materials, or once these patents expire, India will actually have these companies copying those, being able to manufacture those as drugs, and that's a huge growth opportunity for such companies. Similarly, I think in IT you have companies. I mean, like I said, I don't want to talk about these vanilla companies in IT, the usual software service providers, but there will be companies. For example, you can't be a Microsoft, but you can be a big enabler for developer or supplier to vendor to Microsoft in terms of their AI, the AI opportunities. So that's something. These are the two big opportunities we think are growth drivers in the future. So these are the kind of a gist I've made of what we like, but this is not the whole lot. So essentially, this consumption, this is technology, AI, IT and pharma, and energy. These are the three baskets where we think there could be disproportionate growth because of the huge opportunities which lie ahead. And so irrespective of where the markets go, you would see the opportunities here. I won't go to the individual stocks, but just one second. How do you go back? Okay, yeah. Yeah, one second. Yeah. Yes, I'm sorry, I'm just flipping this here and there. So if you look at our portfolio, and I'm just going back to Ampersand right now, um, we are a growth fund, and it really doesn't matter what we think Nifty is going to do or what Indian companies are going to do. Once you understand that stock markets are driven by earnings, what you need to try and grab or invest in are companies which deliver superior earnings. So we try and maximize our portfolio with stocks which in our opinion will deliver the strongest growth. So if you look at our portfolio versus the benchmark, except for the 23, most of the other years, we have had a mix of stocks which have faster revenues, faster profit growth than what the benchmark can achieve. So that's what actually creates the alpha going forward. And of course, if you get valuation support, then the returns could be greater. Um, so these are some of the stocks we hold at this point in time. It's changed a bit. The changes have largely happened in terms of the weightages in the stocks currently we had held, let's say, 6 months ago. For example, 6 months ago, Varun Beverages used to be much higher. Now it's lower. Um, uh, Trent used to be lower, but that's of course gone up because the stock has done well. Zomato, again, the stock has done well. MCX stock has done well. So these are the kind of stocks we own. But again, in each of these companies we own, it's a mix of large, small, and mid. But it really doesn't have any kind of, I mean, it doesn't have a one-to-one correlation with where we think markets are going to go. I mean, markets could probably still deliver 10 to 15% kind of return, or maybe not even that. Uh, but we think that these kind of stocks, I'm just mentioning 10 of those companies, we own 30 of them. So these are some of the representative names which we hold. And this is not a recommendation, so let me make it this is a disclaimer, standard disclaimer, it's not a recommendation, but this is what we hold and this is what we think should do well for us. So we've had people coming back to us and asking us about valuations. I mean, if you look at our portfolio metrics, the valuations are very, very high. It's 47. Actually, it's not 47. This presentation was made about a month ago. When if you actually incorporate some of the numbers of July or the first quarter, the valuations come down a bit. But like I said, valuations should not be the driving factor for why you invest. It's whether growth is going to be there and whether growth is going to surprise in the upside. And that's what actually takes care of the stock performance. And that's what we actually try typically to invest in. Most of the other ratios, whether you look at Sharpe, beta and all, is all quite respectable. Yeah, that's about it. And I think I made a shorter presentation than what you probably guys must have expected, but that's what I have to say. So to summarize, it's not about markets. It's not about where the markets are going to go, because the topic was kind of said, 3 years, markets have doubled, so where would markets go? It's not just about markets. There's a market for everybody, irrespective of where the indices go. That's the point, and that's where one needs to make a value judgment and invest. Yep, thank you.